Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett Fu, really interesting to see all of these geopolitical headlines over the past 48 hours, over the past couple weeks, not really making a dent in ETF flows.
Korea, France, Syria. What more can we say?
What more? Let's get to the biggest stories right now in the more than $15 trillion global ETF industry. And as we were just talking about, stocks wavering right now with the possibility of another sticky inflation print in the U.S. this week and more geopolitical tensions.
As those tensions boost demand for havens, we discuss gold, specifically GLD's 20th anniversary with George Milling-Stanley of State Street.
And in just a few moments, we'll speak with Joanna Gallegos of BondBloxx as the firm launches a private credit CLO ETF, the first of its kind, about one of the investing world's hottest trends. But before we get there, as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now. He's looking at the flows. Eric, what do you got?
Katie, yes, I am. Scarlett, we got a lot of flows to talk about here. Look, we're going to see SPY at the top. This is interesting. Watch this space, okay? SPY is known to be used for tax loss harvesting, especially in an up year. This thing could take in $40 billion by the end of the month. Just watch this. It might be at the top of the list the rest of the year. VTI, Vanguard, a lot of money coming in there. IBIT. A lot of these ETFs here are big theme, which is beta with the side of Bitcoin. That's been the flows all year, and it's been consistent. RSP is equal weighted. That's interesting. A lot of people looking to maybe stay with equities, but a little less Mag 7. RSP and IWM allow you to do that. So pretty understandable flows for the market right now. Let's look at the outflows, and you see this is a little weird. VU, $4 billion. You know, VU's been sucking in money all year. It's got $100 billion still. Had $105 billion at one point. I think this is operational. It could be tax-related or a model switching out, taking profits. TLT, very interesting. You know, we're going to talk about this more in a minute. The Qs, a little bit of profit-taking. Europe can't catch a break. Financials, you know, that was that early Trump trade. Maybe some people taking profits there, too. Let's hone in on TLT. You know, I consider TLT to be the siren song of people who think too much because they're like, oh, recession, then Fed, then this, bonds go down. It's like a lot of mechanics that drive people to buy this ETF, and it hasn't worked. It really hasn't for a while, but people are finally giving up on it. The green line is long-dated bond ETFs. This is intermediate, and that's short. So people still going into the short intermediate part of the curve, but they're leaving the long part of the curve. But look how odd this is. See how these green lines here, about $3 billion each? Look how far back you have to go to get to a green line that big. What was this? COVID, right? Where everybody left treasuries, right? So really interesting, Katie, here that, you know, maybe finally this people are once bitten, twice shy in this treasury trade, in the long-dated side at least.
Perhaps this time is different. Eric, thank you. Joining our conversation now, we have Joanna Gallegos. She is COO and co-founder of BondBloxx. Great to see you in person.
Nice to see you too.
So I definitely want to get your take on what's going on at the long end of the curve, but we have to start with a new ETF launch from BondBloxx. We're talking about the BondBloxx Private Credit CLO ticker ETF, rather. The ticker is PCMM, coming to market last week. One of the first of its kind, private credit CLO ETFs, brand new. Just break it down for us, how a private credit CLO ETF is different from the private, or rather the CLO ETFs that are already on the market.
Yeah, we're finally breaking ground into private credit ETFs here, and this is different from the existing products that are in market today because it focuses on CLOs that hold the loans of middle market companies, and it's structured through a CLO structure. It's similar to what's out there, but it's the first time you've had access to private credit in an ETF, and we're just so excited that this part of the market is innovating.
So talk a little bit about the middle market companies, exposure to that group of companies. What does it really mean? Because we talk about how they're big drivers of economic growth, but if they're so important, why aren't they fundraising through public markets?
Yeah, so you would be probably interested to know that this is a huge component of both the U.S. and global economy. It employs over 300,000 firms there, employs over 48 million people. The revenue from these companies in this category generate $13 trillion. This is no small part of the growth in America. It's just probably these companies don't have access to the capital markets in the same way larger companies do. And that's really what we're talking about here. You're talking about high quality firms that are issuing high quality debt.
So we talk about privates, right? This is a big theme for us in BI, is how do you get something that's illiquid in a liquid ETF? You're claiming to have done it here.
Yeah.
Now, in the Spider filing, where they're teaming up with Apollo, Apollo promises to give a liquidity backstop for the illiquid stuff. How does that work here? What's the equivalent to ensure there's liquidity for the privates?
Yeah, it's the infrastructure itself. So, yeah, we wouldn't argue with you that the end loans here are not the most liquid asset. But when you put them into a CLO, they become liquid. They're securitized. You know, think about it like, you know, this is a CLO is like a bond. It has a CUSIP. It trades in the over-the-counter market. You're repackaging the liquidity in the CLO through the ETF, and that's the connection here. This is a robust trading ecosystem with market participants, and we're accelerating that through the ETF and accelerating the access, which is most important.
So the Apollo ETF would invest directly in those private credits, or that's what they're offering exposure to. In this case, we're talking about a CLO, so you're relying on diversification. If some of the credit goes bad, it's okay because other parts of the credit within that CLO will do okay. But what happens if there's a downturn and everyone needs to renegotiate their loans? That creates a kind of sticky situation.
Well, this is a AAA portfolio. This is a single A portfolio, and you know, you're getting high quality credit of the tranches of these CLOs. So it's a little bit different. These are the companies that are going to pay their debt back first and continue to pay their coupons. So what it takes is a very skilled active manager to select these individual CUSIPs and put them into the portfolio. So actually, you know, this category, you know, it has an abbreviation and it has 3 letters in it, but it's not the same as we've seen in other three-letter structures that didn't fare so well in the way that they weathered volatility moments. In fact, this category has been very low volatility over the last 15 years, has performed really well in the pandemic, hasn't had a default in the broader category ever. This is an industry, the CLO industry is over 30 years old. So again, like a very robust ecosystem for the way these trade.
Great point on the 3 letters there. It's the middle letter that you know, people should pay attention to when they get scared. But I am curious to get your thoughts on true direct private credit. You know, the kind that maybe the Apollo State Street filing is trying to get at. This, of course, going through the CLO route may be a little bit easier to get over the finish line, given that, you know, the SEC is clearly comfortable with CLOs in the ETF structure. But do you see true direct private credit coming to the ETF wrapper? Is that in the future?
Innovation will never stop in ETFs and connecting markets that, you know, like private credit and like private markets. So absolutely, I see that on the horizon. I see that this is direct exposure to private credit. You know, competitive products, you need to look at what's under the hood. This is the only product that gives you the full opportunity set across the credit ratings in CLOs. It's the full opportunity set in private credit. And it is 80% in private credit. So we have to be in private credit CLOs. So it's really important that, like, when we compare products, when you're looking at how much a portfolio may only have 15% in some of these direct exposures, as you may call them, it's about, again, giving clients the full access, the full opportunity. So that's what they want. You're talking about an A-rated portfolio that's targeted to yield around an 8% coupon yield, and it's high-quality issuers, and it's low volatility. And that's what clients have been telling us over and over again. They want to access this spread. They want to access these yields, and this is the way to do it.
Speaking of access, spreads, and yields, you know what I'm going to talk about right now, don't you?
I hope so.
XCCC.
Yeah.
This is the all-junk bond ETF.
Yep.
Triple C's. It's up 28% since you launched. HYG's up 17%. That is some serious outperformance. TLT down 13%. It's the king of the bonds, basically. Yeah, I mean, 100 million is pretty good, but I just don't get it. If this performance happened on the equity side, this would have over $1 billion.
Yeah. It's we're really excited. The Triple C portfolio and actually our consumer credit portfolio are the top 2 performing fixed income portfolios against mutual funds and ETFs last year and a year to date. So it's an incredible space that we've been able to shine a light on at BondBloxx. The yields are still, you know, close to 10%. My line here is always consider this space before you jump back into the S&P 500. The yield is amazing. And people need to be considering bonds again. So,
Yeah, I knew you were going there.
Yeah.
Is it fair to say I nailed this call? Because I talked about it before. It was cool right when it came out.
Absolutely, yeah.
That's true. I mean, I feel like Joanna talked about it before.
True. Well, you launched it. You deserve.
We've been recommending credit since the January of 2023. We've been recommending going intermediate, as you guys were talking about, since the beginning of this year. We haven't liked, the far end of the curve because we thought it was too volatile. There's tons of opportunities here, and at BondBloxx, we're just showing you piece by piece, and CCC is sort of one of our shining stars of how to do that and how to get yield with diversification. And for you to learn a little bit more about what the real volatility is of those markets, you might consider it.
All right. Well, it's great to see you again. Congratulations on the launch. We will certainly be following it closely. That is Joanna Gallegos of BondBloxx. And let's also chat about some interesting ETF news from last week. That is that Goldman is exploring strategic alternatives of its ETF accelerator platform that could include a scale. I actually broke this story, so it feels a little bit strange to bring it up myself. But Eric, I do want to get your take on it. I think it's interesting that you have all of these white label issuers that I feel like they launch something every other day. But Goldman here, it's not quite a white label, but it's pretty close, considering some options.
Yeah, this is interesting. I looked at Goldman. Goldman's, they launched Rubini, GMO. They, to me, seem almost like the C-suite white label issuer, even though they didn't like that term. But the white label issuers, there's 3 or 4 of them. They have about 200 ETFs on the market. And it's real. It's like a turnkey service. I have an idea, launch it. Goldman looking to sell. It's a little confusing, but maybe they're just looking to, kind of cut that and move on.
Yeah. Well, it's going to be interesting to see, especially who the potential buyers could be if they do pursue.
Right. Is it going to be a known player in the ETF world or a newbie? Yeah,
we'll see. In any case, much more coming up. This is Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with one of the big headlines from last week, and that is that MFS is launching its first ETF. Its first 5 ETFs will be actively managed. This matters because they are home to the first mutual fund ever. It was created nearly a century ago. And if you're asking, why are they entering the ETF space? This chart is the answer. You can see ETF inflows in blue, nearly $1 trillion there. You're taking a look at mutual fund outflows in orange. Of course, that has just been a steady pour out of mutual funds for nearly a decade now. So MFS heeding the siren song of ETFs. Let's also talk about daily single stock ETFs, and particularly this one from Granite Shares when it comes to 3 times the return of MicroStrategy. We've talked about volatility drag before. We're talking about it right now because the Granite Shares 3 times long MicroStrategy daily ETP is only up 48% or so this year. And you take a look at MicroStrategy itself, up nearly 500%. So quite a difference there. But let's end with the flows in December overall, because we know that ETF flows have been on fire so far this year. December could be a big month, according to Bloomberg Intelligence, because you have tax loss harvesting flows kick in, and the expectation is that we could see a record this December, Scarlett.
And a lot of it is tied to how the stock market is done overall. So let's talk more about this with Athanasios Sarafagis of Bloomberg Intelligence. And Athanasios, I look at the S&P 500 up about 27% this year. What does that mean for the extent of tax loss harvesting that we anticipate?
So you'd think there's like no losses, right? But let's say if we look at all the U.S. stocks, 40% are down, right? So there's still a lot of opportunity to tax loss harvest. So the way it'll work is you'll sell these losses and you'll park it in ETFs just to still maintain that exposure. But we end up finding when the market is up a lot, so 2021, last year, there is a big tax loss harvesting in December. And it actually is always the biggest month of the year on average. Like about a fifth of all equity flows happen in December.
For the entire year.
Yeah.
Yeah, that's pretty amazing. And I mean, are there any specific ETFs we should keep an eye on, or is this mostly equity ETFs? How does this typically work?
It's mostly going to be equity. You won't get a lot of it in bonds, but SPY is definitely the biggest one. I think Eric was alluding to it on the flows. RSP maybe equal weight. So I think you could have like anything sort of really tied to the S&P, but then sector. So if you're down in a semiconductor stock, you might go into like a semiconductor ETF. So you might see some sector specific ones, but SPY is definitely the big one to watch out for.
Okay, so the losers of the year get pounded even more. How does this set us up for January? What do flows tend to look like after a big month like December?
Yeah, it tends to reverse. It's just like a very short-term thing because you have to wait 30 days just so that, some wash sale rules. So it ends up coming out in January, but it also depends how the market's doing. Like if the market's going to be up in January, you might not get as much of it coming back out.
All right, Athanasios Sarafakis of Bloomberg Intelligence, thanks so much. Get ready for a lot of tax loss harvesting this December. Still ahead on ETF IQ, we're going to drill down into gold with George Milling-Stanley of State Street Global Advisors. That's coming up next. This is Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence back with us for today's Drill Down, where we focus on one ETF. Eric, what do you got?
Katie, today we're doing a legendary ETF, GLD. I don't really think it needs much introduction. It gives you exposure to gold, spot gold. When this thing hit the scene, it was a big deal. It really revolutionized ETFs because people saw you could put other things in it besides stocks and bonds. And it had, until Bitcoin, it was one of the fastest growing ETFs on the market. It's still one of the fastest, but Bitcoin came around. This is sort of the OG store of value. Came out in 2004, 40 basis points. And up until then, storing gold was messy, complicated, full of friction. This makes it easy, and it's $74 billion. Let's look at the other gold ETFs on the market. I figured this would be a useful thing for the second slide here, besides because we know it holds gold. GLD is the big daddy, almost double anything else at 40 bips. IAU a little cheaper at 25.33. Then GLDM, which is the mini-me of GLD, is 10. So a lot of people going into this one if they find this one too expensive, but they're both connected. And SGOL, that stores the gold in Switzerland. Some people like to, they're that concerned about where the gold is. So you can see the choices here. GLD still, despite those cost competition, on top. Let's look at the performance of GLD since it launched. And it's interesting, gold's looked at as maybe something that wouldn't work well in a huge bull market, but over the last, 20 years, it's up 450%. Now, the S&P is up a little more, but gold is beating small caps, it's crushing Europe, and it's definitely beating long-dated treasuries. So for the most part, GLD has worked out in a portfolio since the launch of this legendary ETF, Katie.
All right, Eric, thank you. And joining us to talk about this ETF, I'm thrilled to say we have George Milling-Stanley. He is Chief Gold Strategist at State Street Global Advisors, joining us on set. George, it's great to see you in person.
Thanks for inviting me, Katie. Nice to be here.
So happy birthday to GLD, of course, crossing its 20-year anniversary. And what's interesting, we talk about gold all the time in comparison to Bitcoin, and even with gold at these record highs, you're not necessarily seeing as much as the flow follow through as you might expect. Flows are positive year to date, but we're only talking about $300 to about $400 million. Are you surprised that there hasn't been even more appetite for gold?
Not really. You've got to remember that gold investment's divided across a number of different categories. We've got small bars and coins. There's the large bar investment that is also around, very opaque, not an awful lot of good statistics on that, as well as ETFs. So I think ETFs have gradually become more of a beneficiary of the investment interest, but originally it was just in the bars and coins over the first few years of the last 5 years or so.
Okay, so that's the format in which people might invest in gold, but a lot of people call crypto digital gold. I'm curious whether gold and crypto are complementary or competitive with each other.
I don't think they're competitive. I think that, the main reason why most people buy gold in an investment portfolio is for its protective attributes. It protects against portfolio concentration because of its diversification, it offers you protection against sustained high inflation, against potential currency weakness, against potential weakness in the equity market. Bitcoin doesn't do any of those. Bitcoin correlates very closely with the S&P 500. So it's not offering you the same kind of protections that gold is. The contribution that Bitcoin and other cryptos make to portfolio performance is based entirely on returns. Now, gold has had very good returns this year as well, but I think that the protection was uppermost in most people's minds.
So let's talk about that. I do agree. I think stocks and crypto's like a high beta asset, right? Gold has zero correlation, though, and I think people sometimes confuse this with negative correlation. So, like, this year, stocks are going gangbusters, so is gold.
Yeah.
But gold could also go down when stocks go down. So it's an unreliable hedge, but a great diversifier. Is that right?
I think it's definitely a great diversifier. I agree with you there, Eric. But I think also, look, whenever we've had in history, whenever we've had big downturns in the equity market, then gold has tended to perform well. I'm thinking back to Black Monday in 1987, the bursting of the dot-com bubble in 2000, the global financial crisis of 2008, COVID in 2020. All of those, the equity market went down and gold went up.
So what I find fascinating about GLD, it kind of reminds me of SPY in that it's become sort of this systemically important fund. It's used for a variety of different purposes. When you think about the options market that's been built around it and all the different ways that traders use it. And that explains, I think, in a large way why this is still the dominant gold vehicle, even though it's more expensive than a lot of its peers. And I'm wondering how you've seen the user base of GLD change over the past couple of years.
I'm not sure that we've actually seen it change an awful lot. I think that it's difficult to know exactly who owns GLD because you look at the 13F filings and they're extremely opaque. But we've always figured that GLD was probably owned about half and half by individuals and by institutions, and that's a pretty good mix. But we've thought that for all of the 20 years of its existence, so not a problem there. I think the interesting thing is that with GLD being around for 20 years and having developed an enormous degree of liquidity, that the transaction costs are so low. The entry and exit costs, the cost to rebalance, to maintain a fixed proportion in a portfolio are very, very low with GLD. And that in some cases, it more than compensates for the higher expense ratio. So this is why I think people who want to trade, people who want to rebalance, people who want to use the options market, pick GLD in spite of the higher expense ratio. People who just want to invest in gold and put it over there and forget about it, then 10 basis points on GLDM makes a lot of sense.
Yeah, buy and hold is probably not your base for GLD. I want to talk a little bit about the sources of demand for gold at this moment. You have the People's Bank of China recently ending a 6-month pause in purchases. There's skepticism whether that's actually happening or not. How big of a source of demand is something like the People's Bank of China, given that we're not sure how the economy is performing there?
Let's put all of the central banks together. I think that makes a lot of sense. For 14 years, central banks, primarily in the emerging markets, have been significant buyers of gold for their official reserves. And over that 14-year period, it's amounted to about 15% of total end-user demand. That's been very, very significant support from the central banking franchise in general. And it's not just one or two. We're talking 16 or 17 separate central banks that have been consistent buyers over that whole period.
George, this was fascinating. Hope to have you back soon. Really interesting conversation. That is George Milling-Stanley of State Street Global Advisors. And you can read about this drill down and everything else in ETFs if you subscribe to the weekly ETF IQ newsletter. But that does it for the TV show. We'll see you next week. This is Bloomberg.